Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Larsen.
Welcome back to this week's edition of the Systematic Investor Series with Andrew Beer, as well as myself, Niels Larsen, where each week we take the pulse of global markets through the lens of a rules-based investor. Andrew, it is wonderful to have you back on the podcast this week. How are you doing? And happy Thanksgiving.
Happy Thanksgiving to you. I'm in a wonderful mood this Friday morning and thrilled to be here. So thank you for having me.
Of course, absolutely. It's fantastic. And we've got a great conversation lined up with some more detailed and some new ground to cover. So I'm very excited about it. Now, before we get into all of that, as you know, I'm always curious in terms of things that we are not going to talk about today. What else has kind of passed your radar in the last few weeks since we last spoke?
Well, it's very uninteresting from an investment perspective, but Thanksgiving's my favorite holiday. I mean, it's an opportunity to sit back and just, it's just take a break from everything and just think about all the things you could be grateful for. And then I start kind of going back and get, I kind of go even deeper and deeper and like, we're alive. What? How great is that? We're healthy. We're able to have these kinds of conversations. Surrounded by family and friends. I was in having a Thanksgiving dinner in Brooklyn last night, and in the middle of Mamdani, like socialism central, which I don't necessarily agree with, economically or politically, but the energy around it was wonderful. I mean, you've got a generation of people who are getting excited about politics for the first time. So I don't know. So this will last for a few days, but there's definitely this halo of just sort of general gratefulness and happiness today.
And I know you're too modest to say so, but I will say, given the success that your firm and your trend for or your CTA products has had, ETF this year, there's a lot of things to be grateful for sure. Now, on my side, I shared with you an article, and I wasn't sure whether this was a good time to bring it up or later, but maybe we should just sort of talk a little bit about it, because I know you have some views, and I think this is something that you've actually been, focusing on for some time, without getting into the topics that we're going to be dealing with later. But it was this article based on, I think, on a new Goldman Sachs report about the it's titled "Rich People Have Trillions of Dollars They Want to Give to Hedge Funds," and it talks about this kind of shift that we are seeing in terms of how private wealth is being managed, and the doors that it's opening, according to their estimates, into our world, I would say. So I don't know if you remember the article and some of the takeaways, but I know it's been something that you and I have talked about over the years.
Well, I hope they're right, first of all.
So do I.
Look, I think, and this is something we've talked about over the past few years, is there really has been a seismic shift in asset allocation and wealth management, in that the playbook of 60/40 just stopped working, and the interesting thing about when a paradigm shifts is that most people don't like to talk about maybe the fact that the paradigm that they were invested in broke in some fashion, and this is what's prompting the change. Rather, you just kind of get this gradual shift when all of a sudden, by the way, this was, if you want to get really nerdy, this was written, talked about in a book called The Structure of Scientific Revolutions by Thomas Kuhn in the 1950s. And a new paradigm is established, and then all of a sudden people hop over from the old paradigm to the new paradigm without kind of explaining why they made the jump. And so what's happened really this decade is bonds have not worked as a diversifier. That was the playbook. And in fact, what they've looked like is pretty lousy equity exposure. Less returns, not much better on drawdown perspective, volatility's jumped a lot. And so I think everybody out there on the wealth management side is thinking, how do we build a portfolio given the fact that we can't pretend that this hasn't happened? And so that's causing this, the idea of just, you've now got stocks, bonds, the bond allocation shrinks, and then you've got an other category, a diversifying category, et cetera. When that has been growing in a lot of portfolios, and what we'll talk about is, I think, still zero in a lot of portfolios. But as that expands, then it opens the doors for private equity, private credit, et cetera, into broader and broader groups of investors. And I think what I'm hoping is that, managed futures is one of those really statistically obvious allocations. If you give them easy and efficient ways of investing to it, it'll just become part of the playbook, which I think still today it's still an afterthought for a lot of those allocators.
Yeah, if I'm remembering the article correctly, it also seems to appear to me that they were actually expecting more money going into liquid alternatives, not so much these illiquid alternatives where there seems to be a lot of money tied up that can't get out. So I felt at least that the light was shining a little bit more on our side of the alternative investment industry compared to the private side. And not to steal any thunder for an upcoming conversation that Alan and I had with BlackRock, which we'll publish in a couple of weeks on the 10th of December. But as one of the largest asset managers in the world, very interesting to hear, Jeff's point of view about why they are suddenly coming out with, trend ETFs, just like some of the other big asset managers like Fidelity and Invesco. So that was one of my questions to him. Why this now, and the timing of it. So, anyways, I don't want to steal his thunder about it, but
I wish you. I can't wait to see it.
Well, this is the point of a teaser.
He was so
Andrew.
happy when they launched that ETF. I was probably the happiest person in America when I saw that.
Yeah, that was the point of the teaser, is actually to make you turn on the 10th of December
now,
when it comes
somebody
out.
would tell Vanguard to do the same thing, and then I'll be truly thrilled.
Yes. Well, we don't want too much competition, do we? Anyways, so the other thing that crossed my radar this week was actually I listened to one of my favorite podcasts myself, is the Odd Lots podcast. And I was listening to actually an episode with Cliff Asness that was recorded a few weeks ago. He's always funny and insightful, so great episode. The other one was with Ray Dalio. And a lot of what Ray said is something I'd heard him say before, but then they asked him about the multi-strat, the pot shops, and what his prediction was for them. And actually, he was not particularly bullish about their ability going forward. Maybe not this year, tomorrow, whatever. But I think he was less bullish on the pot shops as a concept, for the future. Maybe to do with kind of cultural things in terms of how they operate inside, and they're not very collegial. They're kind of competition between each pot and all that. Anyways, I thought it was kind of interesting because at the moment, as you and I know, pot shops are kind of the hot thing in the alternative investment world.
Well, I think just to comment on the pot shops for a second, and he may be right. I mean, obviously and I think it's, if you look at it from the outside, you get a lot of dollars of inflows. I can't believe that your 300th team is as good as your 5th team that you've hired. You have an incentive structure where you get this insane competition for talent. But the thing is, you could have made that argument like 5 years ago. And I think at that point, people were saying, with all the leverage, the risk controls will break down, they'll blow up. What they've done is spectacular.
Yeah.
And so they have defied the naysayers year after year after year. And honestly, I hope they do. I hope they continue to do it. It's at least for now, they've invented a return stream that people have talked about in theory as being theoretically impossible, and they've been delivering it. So
yeah. The final thing that kind of crossed my radar, something that people will be certainly familiar with, It's just what's going on in Bitcoin. I find it interesting. It's been pretty volatile, and I have seen some articles. I don't want to get into them because I don't want to, blame anyone. But there are definitely some articles going around about, how this may have been a manipulated pullback in Bitcoin that I found interesting. That's probably all I dare to say about it. As it's some pretty big names that's involved in it. But yes. Anyways, let's go back to something we know a little bit more about, and that is the trend-following CTA world. You and I are recording on the last trading day of November. It's been an interesting month. I'm sure it's been another great month for DBMF, but it's been an interesting month for the traditional world because it's been a bit of a zigzag. Pretty good start to the month. Pretty weak middle part of the month with some reversals and dragging the sort of traditional indices back into negative territory for the month. And then the last few days have actually improved, and we'll see how it all ends in a few hours. Any takeaways from what you've seen your portfolio do in the month? Has it been a lot of change so far, or has it just been really fairly easy for you guys to maintain the exposures you had coming into November?
I don't think. I think we've seen some de-risking of equity risk. So it's sort of been gradual for the past couple of months. One of the things in our portfolios is obviously we're more concentrated in our positions, and usually, sometimes there's idiosyncratic risk associated with that. So I'm sure we probably have more short yen exposure than a typical, more diversified, sort of bottom-up CTA or strategy. It's helped us recently.
Yeah, for sure.
On the other hand, flip side is earlier this year, we had more exposure to the euro when being short the euro, when the euro decided to rearm it hurt us. I think my broad thing about the CTAs this year is just how contrarian it was to maintain this kind of bullish position in the let it run hot trade after Liberation Day. I saw a lot of human strategists who were throwing in the towel and were predicting that we would go into, an imminent recession or inflation was about to take off. I think one of the most florid remarks was a self-inflicted economic nuclear winter was upon us. And it's kind of remarkable that and then throw in a full frontal assault on the Fed in the middle of that. And what's sort of remarkable is actually the world hasn't changed. And the people who maintained this kind of view that interest rates would remain low, it would be good for equities. Gold obviously has been on a historic run this year. It's just and now sort of the dollar is re-strengthening after, kind of the panic around the end of the American exceptionalism trade. Just as a strategist, it would have been really gutsy to take that position 4 or 5 years ago. And so the rebound of the space, which has been really pronounced, is really attributable to being kind of contrarian and early.
Yeah. And do you generally attribute your outperformance this year of the index to, as you say, maybe position concentration like gold, yen, or is there anything else? Of course, also the slowness maybe around April time, I would imagine would have been great, because I noticed that short-term managers have struggled this year. And even though we think maybe when you look at performance of trend followers this month, that's pretty flat, you would think, oh, that's been a quiet month. But I noticed that some short-term managers have had real challenges in November, which the surface numbers don't really explain well.
Yeah, given what we do, and again, for anybody who is not familiar with what we do, we basically, try to, in a sense, synthesize or distill on a weekly basis the broad exposures of the space down to 10 major markets. So relative to an index of hedge funds or the broader mutual fund category, we're going to have 3 primary points of divergence. One is going to be the simplicity of our portfolio means that sometimes not being in other positions helps us and sometimes it hurts us. And my impression was, we have, sort of historically wide outperformance this year, and about 500 basis points of it occurred in the days after Liberation Day. And so the first thing you observed was that as volatile as it was in the major markets, it was a lot more volatile in secondary and even more volatile because really people had no idea what was going to happen to the global economy. And so, what we think happened is that complexity actually hurt portfolios. The more positions you had in more esoteric markets, if you were getting whipsawed, you were getting whipsawed more there. And then secondly, you made a point about slowness. So the second factor is that because we're always looking back in a pretty short it's a rear view window, but it's a pretty short rear view window. We can be a little bit slower to de-risk, and that definitely helped us because when Trump changed his mind, it looked like we had some residual risk on that, which added a couple of points of returns. And then the third is just noise, right? And so sometimes, and happens to every manager. Sometimes you trade, so we rebalance on Mondays. Sometimes it feels like a great decision. Sometimes, you really wish you'd rebalance the prior Thursday or the next Tuesday or something. But I think when you take it together, like the big drivers have really been the first two. Going back to the first point, the idiosyncratic risk issue, I think we've made 4 points on the yen this quarter. I'd be surprised if other CTAs have made that much on it. So anyway, like you take all those things together, and we've had a terrific relative performance tailwind this year.
Can I test something in the most friendly way I can possibly do? When you and I started this journey a number of years ago, and we talked about replication and so on and so forth, and in a sense, I wonder whether you've changed something the way you think about it. But of course, replication, the way I understood it, and maybe I misunderstood it back then, was, all right, well, it's going to be pretty close to the index. That's what we're trying to do. Plus, there could be an advantage over lower fees. So I completely get that. Now, as you rightly put, this year, there's been a very big dispersion between your returns and the index. And probably there's been other periods where that's been the same. So I was thinking about this, and I think we will talk later today about whether managed futures should be labeled differently to what it is. But I was thinking about what you're doing and what you're delivering, and I was thinking, well, maybe instead of it being a replication strategy, to me, maybe it's kind of an alternative data strategy, if you know what I mean. I mean, you're taking other kind of data than we would, because you're taking the performance of an index, but you still produce, and then you put it through your model, and you're delivering a CTA-like return. But to me, I don't know if I feel that the tracking error makes it more difficult for me to think of it as replication, because as soon as I hear that word, I'm thinking, yeah, it's going to be a tracking error plus minus 1%, whatever, because that's what we kind of understand from the equity world, that if you're track a fund or replicate, you're pretty close. I mean, would it be wrong, do you think, to think of you as an alternative data CTA? I know you may not want it because you have to change all your marketing material, but is it wrong to think about it like that, or do you still think no, we just want to do the index plus X 100 basis points?
Well, so you start off with saying maybe your thinking has changed. My thinking is always changing, right? So
right.
And it's as I learn and I think about it. So you say alternative data. We are trying to be the beta of the space, right?
You're trying to be the beta plus some alpha from fees, or
so the original idea was basically when we looked at the hedge fund index, right? The hedge fund index we thought was reported. If you kind of added up management fees, incentive fees, to use very, very simplistic, and implementation costs, which again, these are very, very actively traded portfolios. And 10 years ago, it seemed like 200 basis points was kind of a conservative, but probably pretty low estimate of what the all-in cost would be of a typical constituent of something like the SocGen CTA index or somebody who's running a complicated strategy. So we really tried to aim for SocGen CTA index plus 400 basis points.
Yeah.
And we didn't know how much of that we would get. Like if we try to do that in equity long short, relative value, and other areas of the hedge fund space, we're not going to get all 400. if we think those are the costs. But what happened is over time, it turned out that we were getting all 400 and sometimes more. That has raised a lot of sort of interesting questions as to me, the question is, so the narrative around replication was always, and even a year ago, I mean, I was having this conversation, was always that there was a signal that was being picked up by actual CTAs, which would come from 70 markets, then it expanded to 120 markets, and now it's sometimes multiple hundreds of markets. And that was the true signal of the space. That was the alpha generating signal that people would get out of bed and want to invest in. And I think one of the intellectual questions around replication is, if you can get, and when I say the same signal, I mean the same beta to equities, the same crisis alpha, or however you want to characterize it, the same low correlation or zero correlation of stocks and bonds. If you can get that same statistical characteristics with only 10 instruments, then is the signal itself of the space really a major market signal? And in fact, and that is my current conclusion, is that, and this will get into the whole narrative concept around what it is when you're investing in a CTA. What are you hoping for people in the space to be able to do? And so what I think has happened in 2024 and 2025, where our outperformance relative to the hedge fund index and to mutual funds has exceeded expectations. The other way you could look at it is you could say actually that things that hedge funds are doing are detracting more from value than expected. In other words, they're taking this major market signal and doing different things, whether it's shorter term models or vol controls that are de-risking at the wrong time, or alternative markets or less liquid markets that are getting whipsawed after Liberation Day. Are those things actually detracting from value in the same way that you would say, well, okay, this manager picked the wrong stock at the wrong time, he underperformed the S&P 500? We don't know the answer to that, and we're actually not going to know the answer to that for a few years. But I no longer think that we're picking up a grayish version of this, like this crystal white signal out there, and that it's somehow a diluted version of it. Rather, I actually think I would actually argue it's almost more of a technological innovation of finding a way to capture that signal, but just being able to deliver it with a very, very significant efficiency advantage. Interesting. 9 out of 10 of your industry participant listeners will vociferously disagree with that statement, but that's why we do this.
That's very interesting. Anyway, we'll probably come back to touch on some of those points in the later on. All right. Quick update on performance. So this is probably as of Wednesday evening, since yesterday was Thanksgiving. So BTOP 50 is down 18 basis point, 0.18. It's up 1.05% so far this year. The SocGen CTA index down 66 basis points and down 3.06% so far this year. The trend index, SocGen trend index, up 10 basis points, down 0.79% so far this year. And the SocGen short-term traders index down 1.51% so far this month, down 5.76% so far this year. And based on their vol, that's a pretty sizable number. All right, Andrew, you sent me some wonderful topics that I'm excited to talk about. So I'm going to pass it over to you. I think the first thing you wanted to talk about was a new initiative by Simplify, if I'm not mistaken.
Well, yeah, no. So look, I mean, a U.S. ETF company called Simplify filed a prospectus to launch a new ETF that basically take a step back in terms of the evolution of what we've been doing as a business. So our core replication strategy, which is in an ETF in the US and in a UCITS fund in Europe, was launched in the middle of 2016 as an active strategy, in that we came in on a Monday in July of 2016. We implemented it on a Monday, and then every Monday, or holidays accepted, we've been doing it since then. Same 10 factors, same instrument, it's never changed. And so, it was launched in an ETF in 2019, and then in 2023, it was launched in a UCITS version. So same strategy, 9.5-year track record, different vehicles. In 2024, for the first time, we launched with SocGen an index around the strategy, and there is a whole asset management world around creating indices around, it's often derivative-based or long-short-based strategies where you can identify a set of rules. And if you can identify a set of rules, then a bank or an index provider can then say, this is what the return stream would have been of that strategy historically. Those indices are, people can create them just overnight. And so there's been sort of historically, well, we can create an index on Monday. If it's not working by Thursday, we'll shut it down. We'll launch a new one the following Monday. So there's been but what these have turned out to be very, very valuable tools for sophisticated investors who are looking to get exposure to a particular kind of strategy. We believed, or part of the long-term vision we set out for the strategy in 2016 was eventually we wanted to have an index, back to your point about tracking error, right? So if you are a wealth manager who do not invest in hedge funds, to use the SocGen CTA hedge fund index as a benchmark to decide whether you like the space to build your capital markets assumptions around it, and to use it to benchmark the mutual funds or ETFs that you're investing in, that's where the disconnect lies. Because you can't actually, it's not like if you benchmark a manager to the S&P 500, you have a default. You can say, well, I can instead invest in the S&P 500 in an efficient way. So one of the roles of having indices around different asset classes is to give asset allocators the tools to build better portfolios for their clients. And so the long-term vision for what we did was to actually have an index around the strategy so that somebody building a model for their clients could have 2 decades of data and say, what would have been like if I invested in it? Now, in the fund world, you can show people hypothetical numbers over time, but people are rightfully skeptical of hypothetical numbers. Remember when I would have bought, Amazon in 2002 or something? You can get into kind of like silly stuff. But by 2024, having now proven year after year after year after year this replication strategy worked without changing it, we then could launch an index around it. And so what we've spent a fair amount of time on over the past year is actually taking our business from just the fund management side to being able to talk to asset managers and institutional investors about, if you like the return profile of the strategy that we run, you can also access it through a swap. So you don't have to actually hire us as a sub-advisor. You can go to SocGen or your favorite bank and ask them to build a derivative around it. Now, there's a lot of flexibility around that. It could be it could be a note around it. You could ask them to build a principal protected product. You could ask them to just do excess returns. So that's been the gradual evolution of our business. And now flip over to the US, and now it's also happening in UCITS land. In the US in 2019, there was a change in rules around the use of derivatives and ETFs. And it basically made it easier to use derivatives and ETFs than it had been historically. And so if you look at what a Corey Hoffstein does, right, that works much better post 2019 than it would have in 2015, say. So Simplify is a firm that was launched in 2020 basically to become a skunkworks for this intersection between ETFs and derivatives. So, they now have a $10 billion plus business where they've got 35 or 40 underlying ETFs, the vast majority of which I've been able to see incorporate some kind of derivative underlying strategy. And so in the US ETF world, we obviously we sub-advise an ETF that we've talked about, which I don't like to, I can't talk about too specifically on a format like this. But Simplify has the second largest ETF, which is very different. It's called CTA, and it's run by a guy named Charlie Megara, who's based in London, and they have put up absolutely terrific numbers. And I think they've got around $1.2 billion in AUMs. And what's happened over the past they launched this in 2022, and what's happened over that period of time is we've both been very vocal advocates for the space, and we basically made the argument. When I first got into the managed futures ETF space, is 300 million with two kind of three-legged ponies in the race, and it was my view that we could actually turn this into a strategic allocation across the ETF world. And so anyway, so Simplify has been doing it, but with a very, very different kind of product. They only trade 2 of the 4 different asset classes. They're up 24% or something in 2024. I mean, it's very, very different return profile. So what Simplify has basically decided to do is to try to create a low-cost, index-based, arguably more tax-efficient version of, in a sense, this idea of building the beta of the space, a way of accessing exposure to space. And so we are not a sub-advisor to this. We are not active. We are not involved in setting up the ETF. Rather, it's as though this was an MSCI index or something. Simplify is basically saying, we'd like to create a vehicle for clients to get exposure to it. And they've priced it very low, a 20 basis point management fee, and then a 15 basis points of acquired fund expenses. So for me, it's a very interesting development in that we want asset managers to use the indices and products that we've created so that there's more widespread usage of this underlying strategy that we've developed. Let me pause for a second, and then obviously other things.
Yeah, no, I mean, and that's all good, and that's fine. But I think in fairness, I think on the podcast when we talk about it, I don't want to make it sound like this is a low cost version of DBMF. It's not, right? Because there are other costs. It's just that they're not reported when you use swaps. So in order for them to get exposure to your returns, there is, the normal cost that would otherwise be. So because when I read the articles about it, I was kind of shocked. I said, wow, that's very different. But I think you've explained to me that, no, I mean, there are some other costs, but it's just that it's not what shows up when people say, what are the costs of this ETF that they're launching? Is that correctly understood?
Yeah. Well, yeah. So first of all, I think one of the starting point for me, right, when I started working on this, is that we're penalized. DBMF, the ETF we run in the U.S., as well as our products in Europe, are penalized because investors don't fully examine the all-in costs of investment strategies in general. That if you're trading 10 deeply liquid futures contracts less frequently than funds who trade sometimes dozens or hundreds of underlying contracts, your implementation costs are going to be much lower, right? So the strategy that we built, I mean, the reason the outperformance is so pronounced, I mean, think about 350 basis points of annual outperformance over a decade. The reason it's so pronounced is because there are efficiencies that we've tapped into but if you're only comparing headline fees, you are willfully ignoring that. So I compete with, again, where I saw this is if I'm competing with a mutual fund in the US that has 150 or 170 basis points of expenses, but trades hundreds of instruments, has a 25-page long list of positions in their mutual fund filings, I've yet to find an allocator who's terribly concerned about the cost of trading, 57 different forward contracts on Hungarian interest rate swaps.
Yeah, but
so I think, look, if we create a debate around the true cost of investing and investment, that would be wonderful for allocators.
Yeah, no, I'm very happy to take that discussion, but I think we need to, in fairness, separate it a little bit. I'm talking about fees firms are charging to manage the money, because you could say, yeah, it costs 300 basis points to implement this CTA strategy, but that's not money that the CTA is making, right? So that's just the cost they for the strategy. And I think it is fair, as you point out, that when people analyze these things, they should look at all of that for sure. And I certainly know in my daily meetings and all that, we do get asked, so what are the implementation costs and trading costs and all that? For sure. But I do think, though, there is a bit of a difference when you go out publicly and talk about a product and you have to disclose who gets paid what. I think the managers, whether they're sub-managers or swap advisors or benchmark advisors or whoever, I think we all need to know, what are we getting paid? What are these people getting paid? And this is where when you just mentioned before that Simplify, and that's perfectly correct to say that they've come out charging very low fees. But we also need to make sure that people understand that there are other fees, because you're not doing this for free either.
No, of course.
Yeah.
And the thing is, Niels, people should ask the question,
Yeah.
right? And look, first of all, I mean, I didn't write the articles.
Yeah.
I fully encourage everyone looking at any investment product to think through the implementation costs, including not just how managers are getting paid, but the operating costs of the entities that flow through.
Yeah.
If somebody's charging an incentive fee, then build that into your cost. But you and I both know that investors have different preference functions. And what my primary focus is, I don't want to compete with ManHL or Winton for allocations from a sovereign wealth fund. They are much better dealing with those investors than we will ever be. When you say this statement, what is the asset manager making in this? You know to the penny how much Simplify is making in it. They are the asset manager. They do not have to buy a swap on us. They could buy a swap on somebody else. They could do different things. I think they think probably our strategy is the best strategy upon which they can buy a swap, and therefore they will do it. But you can then ask the question. But my point is that you then should ask the question broadly. My point is that, so look, Abbey Capital is a fantastic firm, right? They are pioneers in the multi-manager space. We do about 350 basis points better than them over time. Okay. 3 reasons. One is there's about in the ETF we have in the US, about 100 basis point performance differential, right? We're also a bit more volatile. Okay. So some of it may just be some volatility associated with, kind of being in a rising market. But there's at least another 100, 150 or something basis points in there that doesn't get explained by just the difference in management fee. And if you look at our, when somebody comes in, you give $100 to a CTA, okay, who has short-term models, vol controls, and lots of different instruments. Your $100 might turn over 20 times during the course of a year. 20 times. Like that may turn over on a notional basis, right? I don't think people realize how much these portfolios trade. So I think a really good question to ask is, okay, you used to have 70 instruments a decade ago. You've got 190 today, okay? Give me a serious assessment of the implementation costs of position 190, because I want to know how you are going to, and how much does that market have to trend to be able to cover that? Okay, maybe it's the Chinese egg market. Okay, let's talk about that market. How are you a multi-billion-dollar fund? How much do you have in the strategy? Of course, these are questions that allocators should be asking. But from a Simplify perspective, I don't think that's who their target audience is. I think their target audience is what I've seen, which is that if you look at the US ETF world, something like 80% of the assets have expense ratios still below 20 basis points. That world is a passive world, right? Where people have put together ETF-only portfolios where between stocks and bonds, and that's really all you have with stocks and bonds, is your all-in expense ratio is below 20 basis points. It's almost all index-based. It's generally tax efficient, and they've got no diversifiers, despite the change in the world that we just talked about. And in my experience, again, with an 85 basis point active ETF, I can make a compelling case to somebody who's say, okay, you've got 170 basis points, 150 basis points, 200 basis point product that performs worse and doesn't help you more in drawdowns. It doesn't help you all these different characteristics. And you have models that have both the mutual funds and ETFs in them. I can make a compelling case for that. Every single person that I talk to also has over here, the unspoken part is a huge and rapidly growing ETF model portfolio that is zero exposure. So they believe in the space. They believe in the diversification benefits, but because of some weird constraints that were put in and how they ended up messaging it to clients, they'll never touch something that can benefit their clients. Look, of the people that I've spoken to in this industry, I think the senior leadership and Simplify have always been of the view that it's almost like a missionary zeal about the diversification benefits of the strategy, but how do you go into the frontier, right?
Yeah.
From an alts perspective? Goldman's report is not talking about ETF model portfolios. Goldman's talking about their prime brokerage clients with equity long short funds and those going up into portfolios.
Yeah. I mean, we have other things to cover. I think my last thoughts on this, and this is not for you to defend, because it's not, as you say, it's not your product, and it's not really specifically about this particular product. It could be anyone doing it. But firstly, before I do that, let me just say that I know you mentioned Appy and all of that, and of course, I don't know anything about their products or anything like that. I just want to say that that's something I usually don't get into too much, and also just based on my own experience, even when you have products that have had a certain outperformance for a decade, I need to make sure that people understand there's no guarantee that these things continue in the future. Yeah. But with that being said, I guess where I struggle a little bit, and that is, and I guess, in a sense, someone could come to Dunn and say, oh, we want to take your strategy, but we'll buy it as a swap. So we don't have to show the fact that we pay you to do it. And so we're just going to show our fees. And I know it's legal, and I know these are the rules and all of that. But I just feel that, as you rightly say, it is good for people to know what are these costs associated with these various strategies. And I completely agree with that in terms of implementation cost and all of those things. That would be wonderful. But I just don't want people to walk away with thinking, oh, now they can actually get your returns for 35 basis points, because that's not what they're getting as far as I can tell. But I think we've probably...
But let me ask you, a sort of a pointed question, right? So how much do you think you should earn over cash over time before any fees?
How much should we earn over cash before any fees?
Yeah.
I don't know about the future. I can only see what has been delivered, of course, yeah.
Okay, so net of fees, the SocGen CTA index has done 300 basis points over cash, right? So let's say pre-fee, that's 500 basis points, and you're a leverage version of it, right? How should people look at your incentive fees? Should you go to them and say, hey, we're going to earn 500 basis points over cash, but we're going to charge a 25 basis point incentive fee, so you should really assume that over a market cycle, we're going to have 125 basis points or whatever the number is of fees associated with our strategy. Like, this happens, it relates to incentive. I completely agree with you. It relates to incentive fees, right? But it relates to having a low management fee, but having more expenses in operating costs of a fund. It relates to of course, these are the questions that allocators should be asking. My only point is, and if somebody doesn't give you a clear answer to it, you don't invest with them. But another angle of it is, and this is my theory around swaps and derivatives on indices, is I believe that there is a lot more flexibility on the structuring side that can also solve things on the tax side for people. And so how do you factor in the tax effectiveness of a strategy? These are all totally relevant questions for people to ask. And, you can look at the returns of the indices that we have. You can ask what the all-in costs are. You can figure out whether that's fair or reasonable. You can still look at the returns before that. You can look at returns after. I mean, people have the capacity to do this. But my point is that in the shades of gray in this business, okay, like there's a guy, Dave Nadig, who's a friend of mine who runs ETF.com. Has this example of kind of white hat and black hat. Okay, like this is like white hat with a gray band around it. I mean, you are still saving, however you calculate it, you're saving hundreds of basis points relative to other ways of implementing the strategies. And so, look, So again, I don't think there's anything, and I don't think anybody's hiding it. I don't think there's anything wrong with it. I just think it's, and I'm fully in favor of people doing an apples to apples comparison on every product in the space. And look, we talked about it before. You've got people who report 0 transaction costs because the UCITS rules are so bad around calculating transaction costs.
Yeah, that's weird.
That they report 0 transaction costs on their kids because they're able to do it under reporting standard.
Let's leave the costs for now, because there's something much more important that you also wanted to talk about, and that is a better way to talk about managed futures and managed futures alpha. So let's talk about that, because there was also, if we have time, which I hope we do, maybe a little bit about stuff you experienced on your last trip to the Nordic countries.
So what I love about this, I'm spending a lot of time, and this has been kind of a recurring conversation. I don't think I've gotten it fully right yet, but I'm so envious of other asset classes that have a wonderful, like, 2-word description of it. Like, I almost went into the LBO business. Now it's called private equity. Right. Like, junk bonds became high yield. I don't know what they'll do with Bitcoin. It used to be cryptocurrencies. Now it's, whatever, digital gold or something. But asset classes have a way of kind of constructing a narrative around it. And I think what I find, so I spent a lot of time thinking, like, what is it I love about this space? Mm-hmm. Right. And what I love about the space is that every now and then it's contrarian, early, and right in a big way. Mm-hmm. That if I was a macro investor talking about the portfolios that we've been running, and I walked into a room and I would say, yeah, well, I'd like, we started shorting treasuries in September of 2020. How early were we? We were shorting the yen just as it was breaking out of its 105, 110 band that had been in for 5 years. We were buying gold at below 3,000. Like, you would talk about a few instances where you truly nailed it. Yeah. And why? Because we're in the business of selling crystal balls. That people make a bet on somebody because they think that they have some kind of a view into the future. And the whole narrative around managed futures is, it's fascinating hearing people talk about it, in that everything is hedged with all these weird caveats, like trend following, and that's not a bad thing because trends sometimes continue more than you would expect. It doesn't sound contrarian and early and right? It sounds like you're part of the crowd who's getting in at exactly the wrong time. So I think the way to talk about the strategy is not to talk about it as a black box, but to talk about it as a crystal ball. And it's a cloudy crystal ball. Okay. This year, it's been a lot more snow globe than it's been, perfectly clear crystal ball. But then the question is why, and how do you explain that to people? Like, how do these guys see the future from only looking at prices? And the narrative there is that, again, so 20 plus years ago, I started what's now a great commodity business called Pinnacle Asset Management. And in those markets, I got to know a lot of people who traded and made money constantly in those markets. And so, a price is hovering around 10 for a period of time, and it goes to 11. Right? If you liked it at 10 and it goes to 11, you're surprised. And for most of the time, you're thinking about, like, should I take some profits off the table or something? Then it goes to 11.50 and then to 12. What's the question you ask yourself? Someone knows something. What do they know that I don't know? And so to me, what I think the whole concept of trend following is not that CTAs themselves have special knowledge, but that in all of these local markets around the world, like, if you have special knowledge about one of these markets, and what do I mean by special knowledge? Okay, a price of an asset is going to change either because the information changes, good or bad, or sentiment around it changes. They're not equal, right? I wouldn't be in a business where I thought just kind of predicting next month's sentiment changes on these different asset classes work. What matters is, because sentiment doesn't drive the yen from 110 to 160. It's a change in information around inflation, around policy, around these big things. So what I think CTAs have done is they've built these global detectors around these local markets to get an early warning sign that something big is changing. And it goes back to what we've talked about the alpha generation in the space. In 2022, it plays out in the yen, treasuries, and crude oil just as much as it played out in 100 different markets at the same time. And so I think if the space, because I go back to, okay, so I'm talking to somebody who has no exposure to the space, and it's not their call, right? They're not a Sharpe ratio maximizer. They need to convince somebody to look at this 3 or 5% of their portfolio and be happy about it. That it's adding something to what they're doing. Would I rather have be hearing about somebody's making money on a breakout in wheat for that? Or would I rather have somebody say, look, it's really hard to predict the future, but we have a strategy here that's sort of like a crystal ball. And it's a cloudy one. And it doesn't work a lot of the time, but every now and then it works really well. So I think if you can give somebody a metaphor they can hold on to, what happens is when you describe something with all these caveats, and we'll talk about this when I talk about my adventures in Stockholm, they feel the need to ask all these questions. What am I missing? They just tell me private credit. They don't feel the need to then tell me that, what are the default rates and the lack of covenants and, only the worst companies are going down and raising money in these routes or something like that. It's like, it's not hedge. It's high yield. It's like you start with the benefit. And the benefit of the space to me in some ways is that every now and then it's a crystal clear crystal ball. And yeah.
I don't know if this is going to help your story as you develop it. I hope so. I'm thinking of the following. So let's imagine that you have this crystal ball that would always be right. Okay. So you go and ask the lady or the man who has the crystal ball, where is the price of Apple going to go? And he says, well, it's going to go from 200 to 400. Okay. But the thing is, if you're a trend follower, if that is correct, then it's going to go from 200 to 201, from 201 to 202, 202 to 203, and so on and so forth. And the way we approach the markets is that we will automatically, without having the crystal ball, but we will automatically, if the crystal ball is right, we will pick that up. That is our signal. So we don't need the crystal ball, actually. We just need to continue, as you say, to have our detectors out and pick up all of these movements. I'm not talking about, the replica. I'm just talking about the underlying models here. And so I think the beauty of it is that instead of us actually having the crystal ball where we know in reality it could be wrong, we can just latch on to when it's right. Now, we'll have some losses when there's whipsawing, all that, I understand. But I look at it in that context that you don't need all the people on CNBC to tell you what's going to happen, because they'll probably, most of them, be wrong anyways. But if they are right, and if it's a market that we trade, then we'll be fine. We'll be there. That's what I'm trying. I don't know. It was not very well explained, but
I think that's I agree. That's the pitch, right? So you don't need insight. I've used this analogy with when they track insider buys and sells of companies. Right? You don't need to know what they know. You just need to know that they're buying or selling their own stock.
Yeah.
Right. I agree. And that's my narrative when I'm talking to somebody who's a bit more sophisticated. Okay. I'm talking about somebody who may or may not know what an ETF is, who somebody has to sit across from them, right, and tell them in a sentence why $100,000 of their hard-earned money is going into this thing. And I think there needs to be a metaphor around it that makes them feel good to have it. Now, I've tried earthquake detectors, as you may recall, right? right? Tremors. I've tried, and I think it's advancing that narrative with, and I believe, I mean, part of our growth is I think I'm winning hearts and minds around certain of these themes. Like I think even focusing on why studying historical prices, which academics tell us it shouldn't work, why it's worked for 50 years, right? And that gets, and who are you taking the alpha from, right? And that's sort of the construction of the argument that it's not us against you, against everybody else in the space. It's all of us against them. And them is every institutional model that when the world changes is not going to change. It's every 60-40 portfolio that was dialing up their exposure to bonds going into 2022 because they needed to rebalance it up. Like, I mean, those are the people who give the alpha. That's why we as an allocation within a typical model portfolio is so valuable, because we're filling a gap in what they cannot do themselves. They're built to be slow, to not be nimble. And the information comes from somebody knows something. I don't need to know what they know or why. I just need to know that they're voting on it with their portfolio. And in a sense, I've used these terms like, it's like almost like Mr. Market is your PM. Mr. Market's going to tell you where you should look. I'm just trying to get one step further, right? Because all of those are technical discussions among technical people of various levels. I'm trying to think about how do you take this space, which ultimately generates its value in a big way. And what everyone really cares about is like, it's going to be annoying in other years, like this year and last year is going to work. Sometimes it's not work, etc. But what everyone really cares about is that period when it shines. And Katie came up with a great expression, crisis alpha. But I'm talking about people who don't know what alpha is. And a crisis for them is maybe I don't know, kids get thrown out of school or something like it's not. It's you're already in a language. And so look, so to me, what happens then, right, is that the trend that you say, you do pick it up at 205 on its way to 400. But that move is because the world changes. There's something different about the stock. There's something different about the economy. There's something different about interest rates or the geopolitical situation. And anyway, so to me, there's something in the positivity of a crystal ball. Because all those people who get on CNBC, they're still on CNBC. We're in the business of selling crystal balls in some fashion.
Yeah.
And so anyway, so this is going to, I mean, plenty of people are going to hate it and feel like it's too abstract and too weird. I'm going to, I think about it from the perspective of I've got to help people who want to have this allocation have a way of explaining it to people who no one wants to get into a conversation about this long short derivative based, leveraged quantitative black box.
Yeah, no, I completely agree with that. Now, unfortunately, because we are running a little bit out of time today, it's actually me with a hard stop. But I do want to get maybe a couple of minutes takeaways from your adventures in the Nordics without stealing anything away from what will be published about it. But if there was something that you felt you could share, that would be super.
Well, so first I'd say, to Cameron and Hedge Nordic, thank you so much for having me. I find these to be incredibly interesting and incredibly valuable. It was a roundtable in Stockholm with, I was there, but then senior people at Links, Aspect, Trends Friend, Gresham, Campbell, Alpha Simplex, Jerry Parker was there, Moritz Heiden was there, and it's really just kind of a free-form debate about the space, talking about things that are happening. What I find, again, I'm always a bit of an outsider. I'm not a quant building these models myself, and I'm always sort of observing it, sort of almost anthropologically. And what I found really interesting this year, I went for the first time last year, and a lot of it was, who are these ETF-based interlopers into our world? And so that was kind of the energy was around that. This year, it was much more about people talking about some of the things I've just described. So shorter term versus longer term models, more esoteric markets versus the core markets, various risk controls, even things like using AI or alternative data sources, like what AQR is doing. And what I found fascinating, and I did make a comment on this at the end of the day, was that you can have two really smart people on other sides of the table looking at essentially the same data and disagreeing about it. And one saying, well, we love this and it's working for us, and the other saying, I couldn't make it work. Now, from my perspective, what's fascinating about that is that by the time that strategy, that implementation, that enhancement is put in front of the client, my experience is it's presented with a certainty. We are adding short-term models because by the time it's presented, that because we will get into trades earlier, and when the inevitable inflection point hurts, we'll get out earlier, and it's presented sort of obvious at that point. Of course you'd want to do it, and there's supporting material. Here's a nice sine wave, and look how much earlier we'll get in, and how faster we'll get out, and think about we're going to make more money on it. And yet there's somebody else who's equally smart who doesn't think it works in the same way, right? And so to me, what I took away from it is, again, it's one of the paradoxes of this business is it's wrapped up in math and markets and price data, et cetera. It's ultimately a totally human business. It is humans making judgment calls about what they decide to include in their portfolios and why, and what they think is going to work, and small changes in assumptions around implementation costs or speed or things like that can have an enormous impact on people do it. And I think the healthy thing is that's also the heterogeneity of the space. And by the way, so Harold and Transtrend and I were kind of going at it a year ago, and I think we were like weirdly agreeing this year, which makes me think there's something fundamentally like upside down in the universe. But it was about the heterogeneity of the space, is having a lot of different people looking at these different things and making different decisions around how they should focus their time and resources. And what it goes back to me is the evolution of the space is an alpha beta separation. That you will eventually have consensus around. There's a signal here broadly that, again, we're hoping to pick up and deliver in an efficient way. And then I think what you'll see is allocators looking, once they feel they can get that efficiently. Like right now, allocators don't feel they can get that efficiently, so they'll take 4 of the 6 or 4 of the 8 people in the room and put them together into a portfolio to try to cancel out a lot of these differences and decisions over time to get something that looks and feels more index-like. But you end up with a lot of what I would call sort of beta adjacent strategies bolted together, which to me is just not very efficient. And on the other hand, I think what you'll see is people if you feel like you can get access to the core more efficiently, you'll feel more comfortable taking a bet on AQR, who's very different from what anybody else is doing. And they've been on an incredible run for the past 5 years, but make no mistake, the prior 6 years, it was a train wreck. And so, but you can take more single manager risk if you feel you have the beta solved. I think it's good for you. I think it's good for Dunn. You can take more volatility. You can take more commodity exposure if you feel like you have a core allocation. So to me, where the space should evolve, and by the way, I think this simplifies master plan basically, is people don't often want 2 allocations in a space. To reduce somewhat, even if it's a passive versus an active, to give them something to talk about in different regimes. When one thing's working better than the other thing, to give them some sort of, in narrative context, a little bit of diversification. And so anyway, so my impression from it was that we're going to be going down a path as the investor base gets more sophisticated. We'll be seeing more of this alpha beta separation on a going forward basis, which I think is healthy.
Yeah, Well, I mean, it's super exciting. It's always great to have you on the podcast. Even if we don't agree on everything, it is what I think I really truly enjoy about our conversation is that we can have these very civilized conversations. And at the end of the day, the most important thing is that more people learn about our wonderful world, and they can choose how they want to implement it. And either way, they get something in their portfolio that the portfolio truly needs, and that's the main goal.
Who doesn't want a crystal ball?
Yes, that as well. That is true. Anyways, my crystal ball tells me that next week I'll be joined by Alan, and I'm pretty sure that's a pretty good prediction. So if you have any questions for Alan, send them to info@toptradersunplugged.com. We'll do our very best to get them in front of him. And of course, if you want to just show some appreciation for Andrew and all the work that he does and in preparing for these conversations, I strongly encourage you to go and find your favorite podcast platform and leave a rating and review that helps more people discover the conversations that we are having every week. So, from Andrew and me, thanks ever so much for listening. We look forward to being back with you next week. Happy Thanksgiving. And of course, in the meantime, until we speak again, so to speak, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.